Okay, we're going to get started today by looking at our calendar. We know from our average monthly stock market returns for the last 50 years, um, July has been typically a really good month. And one of the big reasons why is earnings come out in July. Every 3 months, earnings come out. So because of that, we have a lot of expectations. A lot of times stocks reporting earnings are catalysts for stocks to go up and down. Um, we have a July 4th holiday coming out this week, and I marked the time before and after the July 4th holiday as usually good times. So we expect some positive stock market action around the 4th of July. What's happening on Monday is we have a couple of things going on. We have end of quarter window dressing. So all stocks that have performed good so far this quarter, a lot of managers are going to try to pile into those in the last day. We have a Russell realignment, meaning the small caps stocks um, are being realigned so that there's a lot of action in moving up and down buying small cap stocks. And let me see. And we also have to keep in mind July 9th is a day um, when the president is going to make a decision on tariffs. So most of the tariffs um, deals haven't been made. So we have a good number of nations that are trying to get deals done. So by the 9th, there's a good possibility we're not going to have all these tariff things done. So there's been a correlation to tariff announcements to the stock market going down. So we have like a one-to-one correlation. If there is a huge tariff announcement, um, the stock market is that means there's some unknown, and the stock market sometimes goes down because of that. We saw on Friday, the president said we've stopped our negotiations for tariffs with Canada because Canada had a tax on some of the big tech stocks. And the stock market went down immediately after that happened. So we do know that that's going to be a major issue. We don't know what's going to happen, but you have to be ready for the stock market to correct and or go down if tariffs or some kind of tariff announcement happens in the middle of next week. Not this week, but next week. So sometime in around July 9th, let's hope we get a lot of these tariff announcements resolved or the date pushed back to another time. It seems like there's another pattern in the stock market where there's a lot of bluffing by the president. We stopped our negotiations with Canada. Is that real or is it fake? And immediately the stock market sold off, but it recovered almost immediately. It just seems like you can't base your investing or what you want to buy on what the president says because it seems like there's a lot of fake news stories that are coming out that don't really that maybe are just negotiating techniques. So so we're assuming July is going to be an okay month. Um, we had an amazing month, amazing week this week. We were up like 3% in the stock market. And what else do we have to say? Okay. So the other things we have to watch for is we have the earnings season starting again. Usually the banks start off the earnings seasons. We have Citigroup, JP Morgan, Bank of America. That gives you a really good idea of how the economy is going to be going in the next couple quarters. They usually have comments about the consumer and credit card usage. We have some of the tech stocks starting to report. Google, Apple, is in the middle of August. The last big tech stock to report is NVIDIA at the end of August. So if we look at our monthly charts, after July, August and September are traditionally not that great months. So that's why I have August, September as yellow, meaning very caution and be very careful during those months. We have earnings coming out again in October. So we have every 3 months. That's why October would normally be a better month. Towards the end of the year, we have a traditional rally around Christmas time. That's called a Santa rally. So that doesn't work out all the time, but um, it's a good thing to keep in mind if you're dollar costing into positions, and um, you might have a um, good market at a certain time. So let's look at the S&P 500. Hold on for a second. Okay, so you can see that we have a lot of momentum in the stock market. The S&P 500 right now is above all the moving averages. One of the most important averages I'm watching now is the exponential moving average, the 20-day EMA it's called. And whenever you see a stock or a index where it's starting to go above the 20 EMA, that's a good sign that you're starting to have some momentum. And it seems like the S&P has been bouncing off of this 20 EMA, 20-day exponential moving average all the way up. So um, it looks like, and we're above the 50-day, 200-day, and almost every moving average is up right now, is in a positive slope. So that's all good indications of momentum. We have a 90 in the stochastics, meaning we're overbought, but we've been overbought for several months now. How many months? Around 2 months. So overbought is just a sign where there's more buying than selling, and we have a lot of positive momentum. So we're using this 20-day EMA as our um, guideline for the S&P and for most stocks in the stock market. So it'd be natural for this 20-day EMA to correct back to the yellow line here eventually in a normal market. So we're coming up in a time in, you see, okay, so we're coming up to a time when there's a lot of tariff announcements going to be happening. That could bring us back down to a moving average, but don't be afraid if we correct back down to this average. But that could happen for almost every stock. But we expect the stock market to do good around the July 4th holiday. So good times could be continuing. Let's go to the next. Okay, we're really we are really showing signs of momentum in the stock market. We had 51% of stocks above the 200-day moving average and 63% above the 50-day moving average. So those are all positive signs for the stock market for momentum. We have the 10-year yields going down in the past week. Let's look at that chart for the 10-year. You can see as we have this inverse correlation again. In the last week, the 10-year has gone down a lot, and the stock market has gone up. So let's look at some more things we're watching. All right, so Okay, so the one thing that could, right now, we're monitoring a lot of things that could hurt the stock market. The biggest thing right now is tariffs, because tariffs directly affect the profitability of companies. And if tariffs are enacted and then there's a good chance the stock market might not like that because it involves uncertainty. So that's the one big thing that could cause the stock market to correct now. It's amazing that since our last meeting, we had the United States bomb Iran, and that kind of an action typically is a major market shaking event, but we recovered almost immediately. That was last Saturday. And on Sunday, we had like futures down a huge amount. We had oil up, and by the end of Monday, it corrected immediately and the markets were positive. So it seems like we have a um, very strong market right now. So it'll take a little bit more than a small tariff announcement to make the stock market correct. And we have a buy and a dip mentality in the stock market also. So if you have let's say a major downtrend, there are a lot of dip buyers out there these days. So let's look at some more of our talking points. Okay, so this is the S&P chart mapped out. You can see that we have a prior high. We have S&P nearing or at an all-time high. That was reached back in February. And a lot of times when you have a high from the past and we meet that high, that could be resistance. So prior highs um, could be resistance. The reason is there's a good reason for that. If we had a bunch of people that got into the stock market right there at the prior high, and they they were in a period right now they lost money, and they finally got to break even. There's a certain amount of sellers there because of that. So, and that isn't just for the S&P 500, it's with any stock or investment. So let's keep an eye on this all-time high and keep an eye on these moving averages um, to see how the stock market goes as we go into July. Okay, so let's look at, okay, this is our 5-year chart of the S&P 500. And we can see the low in April seems to be um, corresponding with the lows in this 5-year chart. So if we do get another correction, we'll keep an eye on this long-term chart and make sure that um, where we are. Right now, we're about right here in this chart. So, so we do have a long-term trend that's holding up. Let's look at okay, let's look at some of the major variables in the stock market. Oil is down 13% this week, and that's primarily due to the United States dropped the bombs on Iran last Saturday, and Monday, the United States declared a truce between Iran and Iraq. So that was pretty amazing that in a short amount of time, um, the conflict could be resolved. So that's the major reason why we're back down to the oil level before the Iraq problem. And that's going to affect inflation a lot. With oil price down, that's going to really help cool inflation. All right, so gold is also down. So whenever there's a lack of, whenever the war, basically the truce was announced on Monday, there is a lack of people going to safe havens. and gold has been traditionally a safe haven. Um, okay, but the US dollar keeps going down. As you can see in this chart, we're at a low for this year in the US dollar. That's going to help a lot of the tech stocks. Um, the big tech stocks that are going to be reporting this month, they are going to say this dollar helped them with their international sales. All right, so let's keep in mind the fear and greed index. There's greed in the market. Okay, so translation is caution, take some profits off the table and don't buy. As you can see in the chart here, we're basically overbought and there's greed in the market. And it's not the time to start new positions um, if you're not invested, or if you do want to buy new positions, you have to be very cautious because everyone else is buying. All right. And the American Association of Individual Investors survey still bearish. And translation is it's time to buy or don't sell. So when the amateurs are afraid, um, there's a good chance that those bearish or the people that are afraid that are amateur investors will eventually get sucked into fear of missing out. And that could help the stock market go up. Okay, so let's look at the VIX. The VIX is now at 16. That is really low. So there's not a lot of people that are thinking the stock market is going to be going down. So they're not buying protection and they are not fearful. So that is like a bull market. So let's look at where we are in our emotional graph. We are at greed level right now. So we have all of the moving averages. We have most stocks above their moving averages now. We have a lot of people on TV saying we're at a new bull market and buy. Everyone's positive on TV, and we have this AI theme that's making most of the stock market go up. And okay, so the things that are going to be resolved this weekend, we have potentially a bill being passed in the Senate right now, and they're talking about it. If that happens, we have some good feelings. We also have the July 4th holiday. We have a problem of tariffs that could be brought up. We have lower interest rates, and we have a promise of interest rates reductions later on in the year. So that's all positive for the stock market. So things are working out so that the stock market has a lot of tailwinds. Let's look at the PE ratio for the S&P is at 24 right now, according to the Wall Street Journal. So right now that's pretty high. So usually whenever the 10-year Treasury yield is where it's at right now, 4.3, we have a much lower PE ratio. But right now we're basically in a very extended market right now. So it's kind of dangerous. But if you're a buy and hold person, right now we're overvalued, but over time, your investments will grow into their valuations. All right, so let's look at our first to worst. Um, the technology sector, IT, consumer discretionary were up the most last year. You can see right now that the best sector for this year are industrials. Second is communication services. And the third, utilities and financials. So at the beginning of the year, we said financials would be helped by deregulation, and they would be helped by the promise of a business-friendly Trump administration. We have utilities doing well because there's a lot of demand for electricity, especially with AI infrastructure, AI growth. And let me see, the next IT is coming up as the next best investment for this year. Okay, so let's look at the beginning of the year. We were looking at these sectors of the stock market in the Trump presidency. So deregulation may help um, the utility sector, and AI build out for the data centers would help that. Um, Also, lower interest rates will help utilities because the lower the interest rates go for a 10-year, um, investors gravitate towards dividend paying stocks, which utilities have a lot of dividends. Um, Financials are a clear winner from deregulation, and they're doing good this year. Real estate sector is not doing good. It's one of the worst sectors this year. It's only up 1%, primarily because interest rates have stayed steadily high this year. Um, right now, getting a mortgage is still at sky high rates. So right now, the real estate sector hasn't gone up because the interest rates haven't lowered like we thought at the beginning of the year. All right, let's look at some of the stocks going up and down today. Um, market market movers. Okay, so we can see from the 10-year, we can see that it went down a lot in the last week. So when, okay, let's look at our cheat sheet. When the yields of the 10-year go down, that's positive for small caps, high yielding stocks, healthcare, utilities, consumer staples, home builders, speculative, non-profitable companies that need to borrow, and REITs. Let's see if the 10-year going down will help those sectors today. Sectors, okay. Consumer discretionary is the best sector. Um, Home construction ETF. Okay, we were talking last week about a contrarian viewpoint. Everyone's down on home construction, and because number of home starts, the amount of people buying houses are really low. So as a contrary investor, you have to think about the worst the first. I mean, no one wants home construction ETFs now, but we know that we do know that interest rates are going down. We know that there's a supply demand imbalance. There are more homes needed that are being built. There's an inventory problem. So we have a bunch of things going for this home construction um, sector, but we don't know when it's going to stop, when it's going to be back in the favor. So that's why as a contrary investor, you might want to dollar cost into sectors that are doing the worst. And if it goes down more, then you can buy a little more. Let me see. So it's doing good this week. Let's see, industrial select sector, home builders ETF, and that's doing good because of the 10-year yield is going down. Let's look at the sectors going down the most. Gold. Okay, whenever there was a war, there were a couple wars last week at this time. Um, we had the United States entering into the Iran war. We had Egypt, and we had Iran in a war with Israel. So people were gravitating towards safe haven investments, which were gold. And now people are exiting that trade. So let's look at gold miners, energy. Okay. So the price of oil has gone down 13% this week. That's another reason why energy will be going down. And biotech is going down. Healthcare. These are most of these sectors are safe haven sectors. So healthcare is safe. Um, you have banking is kind of safe. Okay. All right. So we've had a turn from last week at this time. We had safe haven investments that were um, being bought, and now we have a return to risk on. All right, so let's look at Dan Now's picks from the beginning of the year. We see that his best pick is Cisco, which is up 16% this year. They had a really good earnings report recently. The banking ETF is up 9%. So it seems like there's a lot more IPOs that are happening. We have a lot of business friendly things happening in Congress. So that's going to help the big banks. And let me see. All right, so but IJJ is down -1%. This is the mid cap ETF. So it seems like a good portion of the stock market recent rally is the big tech stocks, the Mag 7. All right, so let's look at some of the charts of interest that I picked out. The XLF, this is the banking finance ETF, financial ETF. You can see it's like nearing an all-time high. It's overbought, but it seems like the financial stocks are clear winners from the current presidency, and they're doing really good. Let's look at Abbott Laboratories. This is stock we've been following for a while. There was a new, um, the current um, Kennedy, who runs the health organization now, mentioned the need for devices to be used to track, what was it? He mentioned Abbott Laboratories in his talk as I think Abbott makes monitoring equipment for diabetes, and that was in favor of the Kennedy. So it seems like this stock is in an uptrend. You can see um, it's one of the only healthcare stocks that are actually doing good this year. Let's look at AT&T. AT&T is in a uptrend, and it pays like a 5% dividend, and it's right in the middle of being overbought and oversold. But there is an established trend line here, and um, it's very good trend, and it's in a sector, the communication sector, that's doing really well this year. Let's look at, I looked at the stock screen from this year. I mean, this week I ran a stock screen, and let's look at the stock screen using, okay, I saw a stock called Beazer Homes, which is interesting, and it is a PEG ratio of 0.36. That is pretty low. I thought I'd look at, let's look at just a quick look at the fundamentals of Beazer Homes. Their trailing PE is 7.31. The forward PE is 13. So let me see. So if they're growing at 13, let's look at their profit margin. 3.91 and return on equity is 8. Those aren't that great. I'm looking for at least 11 or 13 in a profit margin. And a return on equity, I would want like 13 there also. So that's not so great. Um, let's look at the earnings estimates for Beazer Homes. You can see from last year to this year, the sales were down. I mean, the revenue, the estimates were down a lot, more than half. So there was a huge drop in demand for their product and sales. So, but look at from this year to next year, they're looking to almost double. Let's do that quick calculation. Okay, 1.85 divided by 3.16. Okay, so they're supposed to grow like 42%, which is pretty amazing for a stock that has a PE ratio of like 18. Or was it? The PE ratio is 14, and they're growing at 42%. So this seems like a boom bust kind of um, sector right now, and it's all dependent on interest rates, it seems. Um, so we have almost every stock that's in this sector has the same issues. That the more that the interest rates yield go up, the 10-year yield goes up, the harder it is for people to buy houses and the demand for housing goes down. But if we're able to have a lower interest rate environment, then home builders do better. So we saw that pickup in the sector. We saw starting to pick up the home builder sector this week. So let's keep our eyes on that. I'm not an expert in home stocks at all. I don't own any home stocks. I am primarily invested in the big tech stocks and the stocks that are in all the mutual funds. But it's interesting to watch the sector just for a contrarian um, topic of conversation. Okay, so let's look at some more market movers going up and down today. Look at this, Nike. It's up 15%. That's pretty amazing. I thought it'd be interesting to look at Nike and their earnings estimates. You can see the earnings estimates from 2025 to 26, they're actually going down. If you look at, so if you look at the numbers 215 by 1, okay, their earnings are going down 20% from this year to next year. That's not really good. I'm surprised they're rallying 15%. Maybe their earnings estimates might change, but it seems like they mentioned something on their quarterly call where things are getting a little bit better. And then I think this 15% right here is short covering. It was better than expected, but it's still they're still expected to be selling less next year than this year. So I would stay away from that one. Okay, what other ones are going up and down? We have a lot of travel-oriented stocks. So Royal Caribbean and Carnival, they had earnings that were better than expected. One of them did. So all the whole industry went up with it. I think Carnival, the cruise lines, there's an overcapacity issue with cruise lines. So there's more seats available, and they have to either um, a lot of the other travel-oriented stocks, such as airlines, they've increased their prices where because there's capacity issues with these the cruise lines, um, they have to keep their prices lower and not increase, with inflation. And that could be helping the cruise lines. Um, let's look at the top decliners. Palantir. Okay, this is an example of an AI stock that has gone up a lot this year, like more than doubled, I guess. Um, so you have a lot of stocks that went up recently that are going down. Um, I don't have anything to say about any of these other ones. Okay, let's go back to our talking points. All right. Um, here's an article, five top bargain stocks ready for a bull run. We've already talked about a lot of these. We know Alphabet's one of our favorites to watch. Um, and Alphabet, of course, is growing around 14% a year. We talked about it a lot recently, but I'm going to go over Salesforce, just see what's going on there. Um, the, this article says Alphabet and Salesforce stocks are in the bargain bin, but both have solid growth opportunities ahead. Alibaba is one of the cheapest stocks out there and is becoming an artificial intelligence leader. AMD has big opportunity with AI inference, and TSMC has made itself an invaluable part of the semiconductor value chain. We went over AMD and Taiwan Semiconductor last week and the week before, so I'm not going to go over those again. Um, Alibaba is a Chinese stock, and um, I can't value those. I've stayed away from those because I don't understand the China market that well. Um, We're going to go over Salesforce. This is one of Jim Cramer's favorite stocks. That could be good or bad. Um, okay, CRM, let's look at their earnings estimates. From this year to the next year, they're from this year to the next year, they're growing 13%. Then after that, 12%, and then 15%. So if they're growing around 12%, their PE ratio right now is 24, the forward PE. So that means the PEG ratio is 2. So they're 2 times overvalued. Let's look at some of their numbers. So the profit margin is good at 16. That's better than 13 we're looking for. Return on equity is decent at 10. Um, so those both are acceptable. And the cash is more than the debt, so they have 5 billion in cash. That's positive. So they're not going to be affected by interest rates. They're pretty big on acquiring companies. So I'm surprised the total debt is um, not too high. They have 14 billion in levered free cash flow, and that is good. So it seems like that they're a profitable company. It's just what you're willing to pay for it. So right now they're double the price. They're 2 times overvalued. Let's look at their stock right now. You can see, let's zoom in on this just a little bit. Okay. Okay. You can see this 20-day exponential moving average. I watch this, to get an idea of when a stock is about to go up. And you can see that, it's been under the 20-day exponential moving average, but whenever it starts like going above it just a little bit, and it's been in like a sideways pattern, like right here for a while, um, that's a good indication that it could be breaking up. And right now it's stochastics are at 68. That's halfway between overbought and oversold. Okay, so let's look at, okay, for me, it's too overvalued for me to be interested in it. I'd rather buy a stock with its PEG ratio is more close to 1. But the good things about this company is Salesforce is starting this agent force. It's kind of an artificial intelligence um, agents that will help perform small tasks. And I'm not too sure exactly how that works, but it seems like it's it's not a cheap stock right now. I'd buy it when it's half the price it is now. Okay, so let's look at another. Let's look at what does CFRA say about it? They have a strong buy for the stock. They said our strong buy rating reflects improving profitability, market share potential, and attractive valuation, while near-term growth faces pressure from tight budget, strong bookings, 12%. Margin execution and agent force momentum support our view. At 22 times CY 2026 earnings, valuation appears compelling as growth stabilizes. Okay, so let's look at where they have the valuation. They say they're undervalued by 5%. So CFRA thinks they're undervalued. I like to look at the free cash flow, and it's going up in a straight line. It looks like it's going up like 10% a year for 10 years. And the earnings are doing really good. You can see the earnings, they're a little bit inconsistent. You can see negative 15 cents, 21 cents, $4.36. Okay. Um, their earnings aren't as consistent as I would like. Okay, let's look at what Salesforce is for Morningstar. Morningstar says they're undervalued by 18%. And they said, let me see, their most recent report were ahead of top end of guidance. Revenue guide of growth of 8% was driven primarily by strength of data cloud, while non-GAAP earnings margins were 32%. So a good thing about this company, supposedly they have strong margins. I didn't see that in the numbers. Let's look at their numbers again. The margins, profit margin, I saw 16%. They said it was 32%. So I might have missed something there. Okay. So for me, this stock is just looks like it's overvalued. I'd wait for it to go down a little bit more, like half of where it's at now. Um, let's look at this list. Every once in a while, I like to look at a stock that's popular in all of the major mutual funds that I follow. Meta is one of the largest positions in almost every one of these mutual funds. So I thought it'd be interesting to go over Meta right now. Meta is, of course, the owner of Facebook, and it runs WhatsApp, a couple other social networks like Instagram. And they're investing heavily in AI. One of their biggest issues right now is they're spending a ton of money on GPUs and artificial intelligence build out of data centers. And they're also they're spending a lot of money on talent. They most recently bought a company for 14 billion just for I think just for the talent. The AI um, workers are very high demand. So they are convinced that AI is going to help them. Um, you can see from the chart here, we are reaching the high that we had back in February. So that could be resistance, but we are in an uptrend here above all the moving averages. Keep in mind this 20-day exponential moving average, and the chart is basically hugging that 20-day exponential moving average. So it seems like every 2 weeks or so we go back down to hit that 20-day exponential moving average. And we are in an uptrend here. So, and we're overbought. Let's look at what the numbers are for Meta. You can see that they're growing around 15%. And the P ratio is 29, so the PEG ratio is 2. That's 2 times overvalued. But you get more for a car that starts. You pay more for the car that starts. So in other words, this is a super quality company. They've been averaging 15% return for at least 10, 15 years. So it's very consistent. So you pay more for stocks um, that return consistently. You saw how Salesforce had inconsistent numbers. You know, it had some negative earnings, and but you can see that its PE is 29. Yahoo Finance thinks it's 2.4 times overvalued. Let's look at what the profit margin is. 40. That is 4 times what we're looking for. Return equity is 40. That's 4 times better than we're looking for. They have around 20 billion in cash right now, and they make 36 billion in levered free cash flow. So that's all amazing. So far, Meta is doing really good. Let's look at the CFRA, what they say about it. They say Meta is a buy. They say our buy reflects Meta's compelling AI monetization potential and digital ad opportunities. Key growth drivers include AI improving and targeting and engaging business messaging revenue acceleration. Meta's AI expansion due to expanding use cases, AI devices like smart glasses and Threads, rapid user growth. The company's massive scale, 3.4 billion daily active users, provides significant leverage for new revenue streams. Okay, so they are an innovative company also. I was sucked into this metaverse. I thought metaverse would take off. I think they've silently killed that project and put their resources and um, employees towards AI. So, but they have these AI glasses right now, and glasses that are augmented reality, which look pretty cool. And that could be a good source of advertising and or um, revenue in the future. So we'll see what happens there. But let's look at their fair value. CFRA did not commit to a fair value for Meta. That's unfortunate. I always like to have a fair value calculations to double check my numbers. Let's look at their free cash flow. You can see that it's going up in a straight, for the most part, in a straight line. And we have earnings pretty much going up in a straight line. For some reason, in 2022, there was a little hiccup. Maybe that was because of the pandemic. I'm not sure. No. But anyway, we have everything in line with Facebook being a really good company. So if we look at the chart, okay, the big picture for this stock is um, it's a it's a compounder that you can buy and basically hold on to, and it'll grow around 10% a year. There's not too many stocks that are reliable, that are consistent, that can consistently return um, at least 10% a year. Um, okay, so here's a story. Here's a Twitter comment from this guy, Grayson Rose. He said, NVIDIA is a textbook breakout to all-time highs after remarkable clean one-year consolidation. Okay, so basically what he's saying is NVIDIA has been trading in this range we mentioned before for a good year now. And there are people that have a theory. If you baseline right like this, you're baselining, and if you break out of that baselining, then there's a good chance the stock will break out and go to higher highs. And that's called the longer the base, the higher in space. There was an analyst on CNBC that said that. So that's what this guy is saying. Let's look at the chart a little better. So you can see this. We're basically baselining right here. We're hitting this um, prior high, and what this guy is saying is we could break out into higher highs, and it's all deciding right now. So we could go back into this consolidation where we go back down to here and go sideways, sideways. But he thinks we're going to be hitting higher highs. And we also have July coming up, which is usually a good month. So that could help it kick it out of this range. All right. Well, I hope you enjoyed that talk. I think that's all I had to say for this time. Hope you have good investing next week, and I'll see you next time.